Hi, everybody. It's Jeff Barton. This is the Mortgage Minute. Thanks for tuning in. Thanks for looking at LinkedIn or Facebook. You can also see what we do on our radio show, KMET, KCAA, K Tahoe, K Albuquerque at K Mine Country, and also at K-Ship, KSHP, 1400 AM in Las Vegas, Nevada. We talk about mortgages. We talk about how our knowledge might be able to help you. And then we also bring to you, during that radio show, several interviews with people in the business that can also bring you pretty good perspective on where the market is and where it's headed. Let's get right to it. Interest rates, 5.65 for the 30-year fix, 15 is at 4.95, 5.12 for FHA, 4.81 for the jumbo, and 5.25 for the 5-1 ARM. ARM products are really making up a lot of the difference in the number of loans that we used to have to what we have today. What I mean by making up the distance is a lot of people going to the ARMs because they're cheaper in the short term, especially if you're planning to either refinance out of that in 5 years or to be able to sell or to get rid of the property. 5-1 ARMs are always a way to go. It's the difference of about a half a point from the 30-year fixed, so that's probably a choice you might be able to use. The 2-year is at 2.94%, and the 10-year is at 2.91. Yes, that's an inversion. Yes, that's a signal of inflation, not inflation, of a recession, and that recession is becoming larger and larger in the rearview mirror as the Fed is trying to chart its course with rate hikes. We saw the minutes come across today. And when did this become just the biggest thing? We have the Federal Open Market Committee meeting press conference where they announce whatever they're going to announce whenever they do that. Last time was 75 basis points hike, but then they wait 2 weeks and get the minutes, and this becomes a big deal for both the stock market as well as the bond market. But it is what it is in terms of how it does affect. They're talking about hawkishness, meaning that they are going to continue to raise rates until inflation is under control, even if it tips the economy into a recession. They don't say that, but that's what a lot of traders are saying. And what I mean by traders is people who are either in the bond market or people who are in the stock market saying that, hey, look what's happening to the overall economy, and yes, we probably will go into a recession either late this year or early next year, and I've been saying that too. The question is, how much of a recession? How long does it last? The conundrum, of course, is full employment equals recession. That usually or never happens. We'll just have to see how it plays out. We do see 11 million jobs still available on the market, even at almost full employment. So, as I said, we'll have to wait and see. The economic slowdown is worse than expected. That comes from Morgan Stanley. The euro is on parity with the dollar. Yes, we talked about that yesterday on the radio show that we record on Wednesday and air on the weekends. The euro, what's happening with oil and gas there, some of the things that countries in that particular region, there's 30 NATO members, by the way, and in Europe itself, which, by the way, Russia is a part of Europe. A lot of people don't understand that, but they are. So what is happening and how does the euro affect what they can buy and what they can sell? If the dollar is this strong, obviously buying American is going to cost more. Obviously here in the States, if we're buying foreign goods, that's a good thing, but it can also hurt the U.S. consumer. So let's see. Several things we're going to go over once again. Housing rise in equity, 19% versus 20% last month, year over year. That's a 1% decline. And that is what we see in the housing sector as well. Both prices are de-escalating. Inventory is up, and therefore the year over year equity that you can expect when houses are sold is going to start to fall. How fast will it fall? When will it fall totally? That is a wait and see, but I say by the end of the year we'll be back down into the 5 to 7% range, and by next year we'll be back down into the normal 3% range on houses and equity rising in those houses. Oil down 8%, gas prices to follow. This is the thing about inflation that really irritates me. Once it gets to a certain level and a number of products, which as Warren Buffett said, it's down every aisle. Anyway, when it gets to that place, it's very hard to reverse the trend because everybody follows suit. I gave my candy bar story last week, $3 for a Snickers bar. Yes, inflation is in every aisle and it is everywhere. Therefore, if you see something like lowering of per barrel oil price, we're now down at about 97, a little below 97 bucks a barrel. We were up at 120 bucks. However, we have not seen the corresponding lowering in gas prices. Why is that? And who's to fault for that? And what economic model shows us that the lag will be X amount of months or days or years? It's just a rough time right now. Housing starts down 13%, new home sales down 17%, mortgage apps down 28% from their peak. We're at 531. I have more to do. We'll see you next time. This is Jeff Barton for the Mortgage Minute.